In this video, you will learn 3 economic events that happened in April, know more about the 3 companies in our eToro portfolio, and I will show you 3 things that I've read this month. Let's get going right now. First things, the bank panic continues, with First Republic Bank that has been seized by the authorities and sold to JP Morgan at the end of the month. This is the second largest bank failure of all times, so this is a big deal. And some say that this is a reminder of 2008, so we will be very cautious in our portfolio and we'd rather stay away from banks. Second point, as the Fed continues to slow the economy, the inflation has gone down. For the moment, the Fed is winning over inflation and it will continue increasing rates until something breaks. It seems like the banking sector is slowly breaking, but not in a catastrophic way. So we will continue to have these high interest rates. 3. We start to see big companies' earnings. And surprisingly, they are not that bad. US companies are performing better than anticipated. Businesses are adapting to this new difficult environment, so they show some resiliency. Yes, it's not perfect because discipline is not here for some businesses, but it can be worse. Speaking of strong results, let's dive into the earnings of 3 of the companies we own in our eToro portfolio. First, let's talk about Pool Corp. They released their earnings and it's a double miss. Revenue and earnings are down. Most of the bad results are due to the weather, so this is a big problem which is temporary. I'm not worried for them. It's not the first time they encounter bad weather conditions that will affect their business, pool constrictions, etc. So there are a lot of issues short term, but the long term trends are intact. Now let's talk about Meta Platforms, the big boy of our portfolio. These latest results were pretty good. 2023 continues to be the year of efficiency and the management is focusing on cost control and return on investment. They did a layoff of 4,000 people. In their earnings released, every metric has improved and they did a very good guidance for the rest of the year. And all this work can be seen in the market sentiment. If we look at the stock price, Meta has done a terrific rebound. You have to think that it's the same business than 1 year ago. And 1 year ago, everybody hated the business, hated Mark Zuckerberg, and now everybody loves it. Some say that for the biggest businesses, very followed, Apple, Amazon, you don't get price swings so often. But in this case, it's the same business than last year, and you see the stock price dropping and then going up. Like, the volatility is insane. We don't forget that the stock market is very emotional and behind every buy or sell order, there is a human. So this is fear, greed. I don't think markets are efficient, even for the biggest companies, very followed companies like Meta Platforms. Meta is a mega cap, so they should be very efficient stock prices. And no, not at all. When Meta was trading at 100, everybody was panicking. And now everybody thinks there is a sound management, cost control, the business is good. It's all sentiment. A couple of months ago, everybody was wondering, is Meta dead? No. Also this month, Alibaba announced that it will be split in 6 units. The business groups will revolve around its strategic priorities. These are the groups: Cloud Intelligence Group, Taobao Tmall Commerce Group, Local Services Group, Kenyao Smart Logics, Global Digital Commerce Group, and finally Digital Media and Entertainment Group. Each of these units can pursue independent funding and do an IPO when they're ready. Management said it will unlock value for shareholders, and this can create more visibility to see each segment operating. If you look at the stock price, Alibaba went up with the news, the big news, then it decreased again because sentiment towards Chinese equities is still bad. We will see how it works out for the rest of the year, but there is definitely something happening here. In terms of performance, our portfolio has kept its steady pace of gaining 1% in April. There is still potential in this portfolio and a lot of our companies are still undervalued. Some people have joined the ship. We went from 2 copiers to 5 copiers. The number of people following our eToro account went from 35 to 58. And the number of subscribers in our YouTube channel went from 21 to 32. So there is some traction. Welcome everybody. Welcome to the ship, to the Christoph ship. Now let's go to the readings. This month, I read The Prosperity Paradox. Let's start with a stunning fact. China was able to reduce its rate of extreme poverty from 66% in 1990 to less than 2% today. That's some big work. But in the meantime, some countries in Africa are in a worse shape now than they were in 1990. And despite the fact that since 1960, we have spent more than $4 trillion in official development assistance trying to help poorer countries. Why? This is the pitch of the book. A lot of humanitarian aid in African countries doesn't help them long term, because they lack durable project incentive. For example, you can create a well in a village in Africa. This will be very helpful for the inhabitants. But let's say 6 months after that, the well is broken. It's a remote village in Africa. There is no technician, there is no wells professional, and the well is kept broken. You have a poor return on investment, and the situation is back to the beginning stage. The author thinks that the development in poorer countries works best if it's through innovation and businesses. The book differentiates pull and push strategies, and the book provides some examples of businesses that created infrastructures, regulation, local jobs. These countries can develop in a better way if they focus on pulling and not on pushing. So this has shown that this works. In this month, I also read Michael Berry's letters and articles. These are letters in 2000, 2001, in this period. And in these letters, we see a Michael Berry, which is a typical value investor, digging where the cash flows are and only investing when the stock is cheap. But it's a specific strategy. There is a very high turnover in his portfolio, which means the stocks are changing in this portfolio. You buy, you sell many times. If the stock is getting polished and the price goes up, he sells and looks at other things. He argues that he invests taking a long-term view, but most of his investments have had horrible long-term stock performance since then. It's not the route that I want to take, but I definitely respect the man. He has a genius mind. It's much more situational value investing, and it's different than what I want to do. He takes the last puff of a cigar butt and then changes his portfolio. Also, he uses EBITDA, and I hate to use this metric. Buffett and Munger hate EBITDA, and they say it's bullshit earnings. So if the two gods don't like EBITDA, I don't like EBITDA. And I will not use EBITDA to calculate my intrinsic value of a stock. It's not that complicated. My two gods are telling me something, I just follow them. Speaking of what the investing gods don't like, let's talk about what they like. And this is a perfect transition to share with you what I learned about Lou Simpson. I tried to gather everything I could find on the internet about Lou Simpson. He was a very low profile, and unfortunately he passed away in 2022 at the age of 85. When Buffett talked about Lou Simpson, he was with eloge. He loved the guy. So I wonder, what did he do? He was managing Geico's portfolio, which is an insurance business owned by Berkshire, which is owned by Warren Buffett. So basically you have Warren Buffett owning Berkshire Hathaway. In Berkshire Hathaway, you have an insurance company. And in this insurance company, Lou Simpson manages the portfolio. That's it. Lou Simpson joined Geico in 1979 as the company's chief market strategist and was named CEO and president of capital operations in 1993. Mr. Simpson achieved an average annual gain of 20% from 1980 to 2004 compared to 30.5% for the S&P 500. So you have a guy managing an insurance portfolio averaging 20% per year for 25 years, and he was a very low profile guy, not many interviews of him, but I have some nuggets for you. Here is his investment philosophy with 5 key pillars. 1, think independently, like many value investors. 2, invest in high return businesses run for the shareholders, so you have to trust management in this field. 3, pay only a reasonable price, even for excellent businesses, something that in the current environment, many may argue about this point. But even if it's a great business, you don't want to overpay for it. You want to pay a sensible price. 4, invest for the long term, which I totally agree. And 5, do not diversify excessively. You don't want 50 stocks, 100 stocks. He says if you have 15 to 20 stocks, that's the maximum. You can't keep pace and watch 50 businesses. You want to be very focused in your portfolio and know the portfolio you have very well. He was in the same spirit as Warren Buffett, and this shows you again that This investment method of investing in great companies for the long term, this works. Now I have started reading a book about a potential war between China and the US. Can they avoid a war? That's the point of this book and the different scenarios that can happen. And that's it for today. If you want more content like this, don't forget to subscribe, to like and comment. I wish you a good day. Bye bye.